Listen carefully, because what's happening in silver right now is something you will not see again in your lifetime. Silver has blasted past $62, yet dealers across America are dumping inventory below spot like they're bracing for a crash. Retail buyers are frozen, coin shops are quiet, and industrial giants are quietly hoarding every ounce they can find. This is the exact moment where most people hesitate and get left behind. I'm going to show you why this market looks broken on the surface, but underneath, it's setting up for the biggest shortage the silver world has ever seen. If you think $60 is expensive, you're about to find out why this isn't the top. It's the warning shot. Welcome back to Noble Billion News, the only place where you get real analysis, not recycled talking points. I'm Dr. Shah, and right now silver is trading at $62.89 and climbing while I'm speaking. Most channels are celebrating, jumping around like this is the endgame. They're missing the point. When a market doubles in under a year, serious players don't get euphoric. They get cautious, strategic, and brutally honest about what's actually happening under the surface. Silver started this year under $30. Today, it crossed $63 intraday, and instead of FOMO in the streets, we're seeing fear, confusion, and dealers behaving like a crash is imminent. That tells you this isn't a retail-driven rally. It's structural stress. And structural stress doesn't disappear because someone posted a bullish meme on Twitter. People watching charts think the whole world is partying. But the physical market is giving you the real truth, and it's uncomfortable. Walk into local coin shops in the US, and you'll notice something strange. Silence. Foot traffic is there, but nobody's buying volume. Dealers at the Joplin Coin Show were dumping high-premium coins like kookaburras, koalas, and even limited libertads below spot. Not discounted, below. That's not euphoria. That's fear of being caught holding overpriced inventory in case of a sudden correction. One dealer printed new price tags every few hours just to stay ahead of spot because he said, "I don't want another 2011. I'm dumping everything until this stabilizes." The irony is that the same dealers terrified of downside are also admitting privately that replacement cost is a nightmare. If they sell at spot today and silver jumps $2 tomorrow, which it has been, they're underwater instantly. When bid-ask spreads widen like this during a bull market, that's structural distortion, not normal trading. The latest data supports this. Spot hit $63.08 yesterday on Trading Economics. The gold-silver ratio broke 75-1 for the first time in years. These aren't small signals. They're pressure signs inside a stressed supply chain. And Kitco's intraday volatility is showing exactly what refineries and wholesalers are struggling with. Hedging risk has gone vertical. A Michigan dealer with 50 years in the business said yesterday that his margins have collapsed. He used to make $8 to $12 an ounce when silver was $20. Today, he makes $3 to $6 on a good day. Stackers who were buying 10 ounces a week a few months ago can now only buy 4 or 5. Dollar cost averaging mathematically still works, but sentiment-wise, the average buyer is paralyzed. They want silver, but they hate the price. And that psychological conflict freezes markets. Here's the uncomfortable truth. The physical market is not celebrating because it doesn't trust this move. It's moving too fast, too violently, and too early in the cycle. Dealers are acting defensive. Retail is acting scared. And institutions, the ones silently absorbing physical, love that fear because it gives them access to metal without retail competition. This isn't a top. This is a liquidity bottleneck forming right before the real mania. Part 2. Now let's zoom out and bring in the higher level analysts because their commentary reveals the real battle lines. CPM Group, Metals Focus, UBS, and ING have all revised their targets upward this quarter. They expected $40 to $45 averages for 2025. Silver blew past those numbers months earlier than modeled. Jeffrey Christian admitted last week that the physical market is tighter than anything we have seen since 2011. Coming from CPM, a group known for conservative outlooks, that's not noise. That's a warning. ING's commodities desk says industrial users are in panic procurement mode. Over 60% of global silver demand now comes from industries like solar, EVs, and tech manufacturing. That means the strongest buyers aren't stackers anymore. They're corporations with non-negotiable timelines. And refineries are struggling with hedging margin calls due to violent price spikes. When silver jumped $2.50 in one afternoon last week, several refiners temporarily halted forward hedging. That's the kind of thing that happens right before supply chain freeze-ups. Bloomberg Intelligence just published updated numbers. Global mine production down 1.2% for 2025, while total demand grew 8%. That's a fifth consecutive annual deficit above 180 million ounces. No metal market in the world can sustain that without cracking. Compare this cycle to 2011, and it becomes obvious why $60 is not a peak. It's the warm-up. Back then, industrial demand was minor, and the rally was almost entirely speculative. Today, industrial buyers are the backbone of the move. Tesla, Samsung, TSMC, First Solar, these are billion-dollar entities that cannot afford production slowdowns. They don't buy dips. They secure supply. They lock contracts. They outbid retail instantly. That's why Ole Hansen from Saxo Bank said yesterday that we are no longer in a normal market. We are operating under shortage psychology. Let me be blunt. 2011 popped because retail lost nerve and COMEX margin hikes knocked the legs out. That playbook won't work today. Corporations don't panic sell. They don't stop buying because Reddit is scared. They buy in predictable waves until their supply is secure. That creates a price floor so much stronger than anything we've ever had. So if you're still comparing 2025 to 2011, you're thinking too small. This is the first time silver has both retail fear and industrial desperation at the same time. And that cocktail is explosive. From my perspective, analysts are still behind the curve. None of them are modeling a scenario where industrial buyers go fully vertical. They think this is fast, but this is the slow part. The acceleration phase hasn't even started. Part 3. Here's where sentiment becomes the driving force. 6 months ago, at $28 to $32, everyone was screaming, buy the dip. Now at $63, those same people are paralyzed and praying for a 50% crash so they can finally get in. That's not strategy. That's emotional convenience. And emotional buyers always lose. Dealers across Texas, Florida, Arizona, and the Midwest all report the same thing. Tons of lookers, few actual buyers. A Texas wholesaler told me he sold only 11 ounces on Wednesday, at a time when silver rose $1.60 in a single day. Customers walked in, stared at the price, whispered, "This is too much money," and left empty-handed. Those are the same people who will be paying $90 to $100 later and calling it the new normal. Perth Mint confirmed yesterday that November silver coin and bar sales collapsed 42% month over month, while spot surged. That tells you retail is exhausted. Wallets can't keep up with the price velocity. But here's the twist. Industrial demand doesn't slow down because of price. It accelerates. The Silver Institute reported solar demand for 2025 at 230 million ounces, nearly a quarter of global supply. That's just one industry. If you think retail hesitation will pull this market down, you're misunderstanding the fundamentals. What replaces retail when they step out? corporations with billion-dollar contracts. That's exactly what happened to rhodium in 2020, went from $2,000 to $29,000 because automakers had no alternative. Silver is now entering the same phase, a required metal with no substitutes at scale. And once a metal becomes required, price becomes irrelevant. The psychology shift is deadly for latecomers because once industrial panic begins, there is no retracement large enough to help the average buyer. The dips become small, fast, and aggressively bought by entities with deeper pockets. That's why I keep saying, fear buys silver earlier than greed does. Part 4. Now, let's break down availability and premiums, because this is the part most stackers misunderstand. Premiums collapsing does not mean silver is cheap. It means spot is rising so fast that premiums have been mathematically crushed. Dealers who used to charge $8 to $10 over spot are now forced to take $1 to $3, sometimes $0, because the total price is already high enough. But availability is tightening, not loosening. APMEX, SD Bullion, and JM Bullion have pushed shipping dates into February and March 2026 for core items. Hundreds of SKUs that were in stock last month now have estimated delays. That's not supply abundance, that's supply chain exhaustion. When silver moves $2 to $3 in a single afternoon, refineries cannot hedge new production safely. That risk alone slows everything down. The US Mint is still failing to meet Silver Eagle demand even after promising higher output this fall. They're still on allocation. This is the worst output per demand ratio the Mint has had since 2008. Meanwhile, industrial buyers aren't waiting. They're bypassing dealers and negotiating direct with miners for 5 to 10-year offtake contracts at premiums above spot. When that happens, retail is locked out. That metal will never hit shelves, never hit online dealers, never reach your local coin shop. It goes straight into factories. We also need to mention backwardation. 1-month lease rates jumped above 4% annualized, a huge red flag. Backwardation in silver means immediate delivery is more valuable than future delivery. That only happens in physical stress conditions. If we continue down this path, the retail market could experience short-term outages, even if COMEX futures pull back temporarily. You might see silver drop $3 on the chart, while physical supply is unchanged or tighter. My analysis? Premiums are temporarily low, and this is your smallest window of opportunity. Once this market enters full industrial panic mode, premiums will surge again, availability will crater, and dealers selling below spot today will be rationing ounces tomorrow. Part 5. So let's finish by asking the only question that matters. Where do we actually go from here? The fantasy of a 2011-style 50% crash is exactly that. A fantasy. The fundamentals have changed beyond recognition. We have a structural deficit, declining mine supply, industrial panic buying, geopolitical instability, US inflation that refuses to die, and central banks increasing gold purchases at the fastest rate since the 1960s. Silver does not collapse under those conditions. Goldman Sachs and Bank of America both raised their 2026 silver targets above $70 this week, with some scenarios projecting $100 plus if industrial shortages intensify. And yes, $100 plus is not a crazy number anymore. It's realistic. My roadmap remains the same. Gamma squeeze into the mid-70s, retail FOMO into the 80s, industrial capitulation above $100. And the corrections along the way, 15 to 25% pullbacks, will be brutal and fast, but they won't break the trend. If you're on the sidelines, mining stocks offer the only leveraged exposure without fighting physical premiums. Unhedged producers in safe jurisdictions with low costs, that's where real upside is hiding. Physical is still essential, but the era of cheap physical is done. You don't get $20 premiums anymore because we don't live in a $20 silver world. If you're stacking, understand this clearly. Dealers selling below spot today are not bearish. They're scared. And in commodities, scared sellers disappear fast. Once they're gone, only expensive metal remains. Thank you for watching Noble Billion News. If this breakdown sharpened your strategy, hit subscribe and turn on notifications right now, and drop a comment below. Are you buying at $63 or waiting for a dip that might never come? Let's talk about it. Stay sharp, stay stacked, and I'll see you in the next one. Dr. Shah out.